When the world loses confidence in the dollar, then they're not going to be willing to sell any of their goods for dollars. So it's really kind of two different answers depending upon whether we're looking at just purchasing power here or taking a broader look globally, the dollar against those other currencies. Because it's, regardless, it's all a race to zero because it's all on a debt-based system. And I can see a time, I definitely do see a time, where you'll have the dollar will just be a local currency, not a global currency anymore. I mean, I remember going to France, and this would have been like in the 90s, and that they preferred to get paid in dollars rather than francs at that point. It was the early 90s, so it was before the euro, and they wanted to get paid in dollars. Would they want to get paid in dollars today? No, they don't want to get paid in dollars. So there's two different ways to answer that. Either way, the dollar's value globally and locally is headed towards zero. Even though they'll come out with a new currency and it'll still be called a dollar, the digital dollar. But the dollar, the debt-based dollar that we have right now is 100%. It's headed towards zero and very close to that. I don't personally hold a lot of debt, and I could pay my mortgage off. I mean, it's small enough, I could pay it off, but I don't do that. Instead, the money that I would have used to pay that off, I've simply, as you know, put into gold. Mm-hmm. So when that reset happens, that overnight reset happens, and you see gold go up, then there's going to be a window where you're going to capture some of those gains and pay off that debt. So you just have to be paying attention, but you've got to have gold for, especially when you're talking, variable rate debt you want to get rid of, I'm going to tell you. You want to get rid of that and get rid of it now because we see what's now happening with interest rates. Mm-hmm. But fixed rate debt, why not pay it back with cheaper dollars? And there's no doubt about it. I mean, we just did a recalculation of the fundamental value of gold, a month or so ago? It's not necessary to do it constantly. But it was 13,500 or something like that. Mm-hmm. And spot is at like 1,900 and something. You can do the math. The whole world has agreed that this is money because it meets all the criteria to be a good money. So demonetize, no, they already tried that. Has it worked? No. Why are they accumulating it? Because it's money. Because it's good money. It's hard money. It's savings-based money. In my personal strategy, where I thought that I would convert, a chunk of it once there was a component of gold in the new currency, I'm not planning on doing that anymore because I'm not willing to give them that much control. Mm-hmm. So, I might do as much as I need on a monthly or quarterly basis or something like that. But because I don't want to give them total control. And the way to keep a level of control is to have real money outside of the system and then just put it into the system as you need it if you have no choice. So, yeah, you're not going to have, once they put the CBDCs in place, that will not fix the problem. Let me be really, really clear on that, because they aren't going to change behavior until they're forced to. And the only thing that's going to force them to change behavior is the loss of confidence of the public. Public says, I'm not using that currency anymore. I don't want to take it anymore. That's why you see them in Venezuela using gold and Zimbabwe using gold, using anything other than the local currency because they don't trust it. To be perfectly honest with you, the lion's share of my personal holdings is definitely gold, but silver is the secondary monetary metal. And for me, I think it's absolutely perfect as a universal tool of barter. Plus, it's easy to get them in different sizes, etc. So I don't stack platinum or palladium. I mean, I do own some platinum, but I definitely don't stack it. I just stack gold and silver. Russia creating a petro ruble or a gas ruble, however you want, a commodity ruble. But the other thing that they're doing is putting a floor underneath the price of gold. So they're doing two key pieces. Now, the US dollar officially in terms of purchasing power is already at 3 cents. And with this rapid inflation, approaching that 0 point very, very quickly. But it really is all based on confidence. So how long before the US dollar goes to zero? Well, we're pretty close to that now, and I can't give you a specific date because, again, it's just based on the confidence that the world has in the dollar. But there are a lot of things that are happening that would definitely indicate that the US is losing its position as the world reserve currency so soon. That's the best date that I can give you. I don't know exactly when. Anybody that's holding dollar assets can make that deposit into that substitution fund, and then those would be converted to SDR, special drawing rights, which is the currency of the IMF. Now, the consequences of the precious metals are huge because right now, as long as people have maintained confidence in their currencies, whether it's the dollar or the euro or the yen, depends on where you live. But as long as people maintain confidence in the currencies, then it benefits governments and central banks to suppress the visible price that you see in gold and silver, because a rising gold price is an indication of a failing currency. But when that confidence is lost and they have to regain that confidence, that's when you will see the gold and silver, but mostly gold because that's what they reset a currency against, go to that fundamental value. So the consequences is much higher from here. You know, right now when you watch on TV, like you may have noticed that the ruble lost a lot of value against the US dollar, and now it's back to pretty much where it was. So that's one measurement, and that is frankly typically the only measurement that they ever talk about on, you know, CNBC and Bloomberg and the newspapers and all of that. So it's just one currency that's purchasing power is headed to zero against another currency whose purchasing power is headed to zero. I'm pretty darn sure that if we had the ability to talk to just a normal average Russian citizen that's living there right now, they didn't suddenly match.
The unallocated London gold market, it's not appreciated that much. That basically gold, you know, Paul Volcker in the 70s said gold is my enemy, right? Gold is the enemy. Gold, it's not the enemy. It's like saying a thermometer in Arizona in June is the enemy. You know, it's not the enemy. It's just you're in Arizona in June. You know, it's friggin' hot. And so in the same way, the way central bankers have managed, you know, it was their enemy because they would have to tighten rates when they didn't want to tighten rates. Right? It was forcing them to actually exercise discipline. What they have done to control these markets has been to allow the robust expansion of paper gold. Unallocated gold in London in particular, where there are unallocated over-the-counter claims, who knows, it's been estimated anywhere 20x, 50x, 100x, 1000x, nobody knows. Mm-hmm. You have some guesses, they're all guesses. COMEX also, it has gotten more paper driven. I mean, I had one of the biggest physical gold traders in the world tell me, I think 4 years ago, that, you know, when he started in the business 20 years prior to that, you know, probably 20% of the volume on COMEX in the gold markets was at least related to a physical ounce. He's like, that's now probably 2%, and the volume's probably risen 3, 4, 5x. So they've basically, it's not the same thing in COMEX as it is in unallocated, but the bottom line is if you have inflation, and that inflation drives and monetary inflation, you expand the monetary base, you run big deficits. If that drives gold demand, there's two ways to deal with that gold demand. You can let the price of gold rise, more dollars chasing the same gold price up, or you can let the number of paper claims on gold ounces rise. And that way, with that, you can manage the pace of gold's rise. That's what they have chosen to do. That though, is the weak link, because if you look at COMEX inventories, a small hedge fund could go to COMEX and say, I want to take all of it and break the market. The fact that they don't, there's an extraordinary informational value that most people just ignore. The fact that some small hedge fund hasn't gone and created a short squeeze like they did in AMC or like GameStop last year, right? Why not? The why not is because you get talked to by someone who has haircuts like ours, and they're like, you don't understand. That's not going to happen. We're going to cash settle you, and you will be persona non grata, best case. And that's just, again, this is statecraft. Gold is not just some free market. It is a political metal. And so now, if you're going to do that, if you're going to do the Hunt Brothers short squeeze, right? I'm not speculating. The Hunt Brothers tried this in silver in 1980. The system has to protect itself. The Hunt Brothers were not a sovereign. The Hunt Brothers were not the biggest oil exporter in the world, like Russia is. The Hunt Brothers did not have nuclear weapons. The Hunt Brothers did not have an army. The Hunt Brothers were not closely allied with China, who's the world, so on and so forth, right? It's a very different game at that level. And that's why I say people underappreciate the leverage that the energy that Russia has as their real currency could be. What if Russia comes out and just says, listen, we and China have agreed that to get around sanctions, we are going to transact in, we're gonna settle gold, or oil, excuse me, in physical gold at a new ratio of 1,000 barrels per ounce of gold. And everyone is going to go, oh my God, this is a great arbitrage, right? I'm gonna go buy 1,000 ounces of COMEX gold or GLD, and then I'm going to convert it to physical, and then I'm going to take the physical over to Russia, and I'm going to get 1,000 barrels of oil, and then I'm going to sell the oil, and I'm going to get rich. And the market properly is going to shut down. It's going to crash instantly. The paper gold markets will just go boop, cash settle everybody, game over.
And you brought up chapters 1 and 2 from Currency Wars, where you basically highlight this scenario. You said the scenario you presented at the time was that Russia and China would accumulate large gold reserves, pool their gold, and launch a new digital currency backed by gold in the place of the US dollar. Is that the form it would take for you, something backed by gold?
Probably, and here's why. And by the way, when I wrote that, and when we did the war game, and when I wrote that, Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about, because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. But everyone's like, well, the Chinese yuan is going to be the global reserve currency. No, and it's not going to be the ruble. But here's why. Well, there are a lot of reasons, but the main reason is, when you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. So if you want to suggest or hypothesize that the Chinese yuan is going to replace the US dollar as a global reserve currency, where's the yuan bond market? I mean, it doesn't exist. Very small scale, very illiquid, no primary dealers, no win issue trading, no auctions, no repo, no settlement clearance, none of the plumbing and the mechanics of a mature bond market such as the United States. And above all, they don't have a rule of law. I mean, at least if somebody reneges on a treasury bond, you can sue somebody, but you can't do that in China. So the absence of the rule of law, number one, the absence of the infrastructure, the plumbing, for want of a better word, are two reasons why the yuan and certainly the ruble will not replace the dollar as a reserve currency. However, what I was hypothesizing then, and I would come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. But they don't have bond markets, and they're not going to have them soon. So the yuan and the ruble aren't going to replace anything.
I guess to wrap part one of this very thorough discussion, I want to get back to really the main point you're hammering home here, is that we're on the verge of a global liquidity crisis. How does that domino effect play out? How far are we from this really erupting to that global crisis, Jen? Does it happen exponentially from here? Does it take a few years? Where are we at?
It's more the former. We are uncomfortably close. Now, it's impossible to know exactly how close because it's a complex dynamic system, and you can make very good predictions on complex dynamic systems as to the magnitude of the crisis, but it's very hard to get the exact timing. But because you never know what thing is going to trigger it. But I can say that we're uncomfortable because now we've been there twice before in recent years. 1998. We came within hours of shutting every market in the world. Began with a Russian default, by the way. August 17th, 1998, Russia defaulted on their external debt, and the ruble was grossly devalued. That started a global liquidity crisis, went around the world, ended up in my lap at Long-Term Capital Management, where we had $1.4 trillion of derivatives. And everyone goes, oh, long-term capital, you guys lost a lot of money in Russia. We didn't. We lost maybe $100 million in Russia, but we lost closer to $4 billion on everything else, because in a liquidity crisis, people sell everything. It's not a question of, do you have Russian bonds? It's like, no, they sell everything. Spreads widen. Not enough collateral, margin calls, people being blown out of their positions. That's what a global financial crisis looks like. We cured that with a $4 billion all-cash injection sponsored by the Federal Reserve and two rate cuts, one on an emergency basis by Alan Greenspan. We got through that, but we came within hours of shutting every market in the world. Same thing in 2008. We all know, September 15, 2008, Lehman Brothers. Okay, people don't realize that Morgan Stanley was days away from failing. Goldman Sachs was days away from failing. John Mack said so at the time. Lehman was begging for help. He said, "Sorry, I got enough on my plate. We're worried about Morgan Stanley right now." And then the Fed came in, and so think of it as dominoes are falling. So all the dominoes are falling, and they're going to keep falling unless you truncate it, drop a wall in, and that wall was the Fed. But here's my point. Each bailout gets bigger than the one before. Each crisis is more dangerous than the one before. So 1998, 2008, here we are in 2022. We're going to get to a point, we may be there, where the crisis is actually bigger than the Fed, bigger than the Fed's ability to stop.
The silver squeeze, as we've discussed before, or what's commonly called the silver squeeze, which is millions of retail buyers buying silver, netting silver to their portfolio, has been important, I think. But the real silver squeeze, from my point of view, comes about when the largest institutional investors in the world recognize that the 40% of their portfolios that they have involved in debt instruments needs to be changed. 40% of institutional portfolios aren't performing, and the institutional managers are going to need to change their investment behavior. And I believe that some amount of that money will find its way into the silver market. And I don't think that there is sufficient silver, or certainly silver equities, to satisfy that demand. Specifically, and we've talked about this before, the market share of precious metals and precious metals related assets in the United States market for savings and investment is less than 0.5%, which is to say 0.5% of the savings and investment assets in the United States market are made up of precious metals and precious metals related securities. Historically, the mean valuation of precious metals and precious metals related assets, or put differently, the market share, has been between 1.5% and 2%. At the very least, over the next 5 years, pardon me, I think that precious metals will return to mean, which means that demand for precious metals and precious metals related equities in the United States market, the most important savings and investment market in the world, will triple or quadruple. In my heart of hearts, I don't think that we're going to have reversion to mean. I think that we're going to overshoot mean, but I don't need to overshoot mean to make my case. A circumstance where the Harvard University Endowment, the Stanford Endowment, Teachers Investment and Annuity, the Saudi Sovereign Wealth Fund, the Chinese Sovereign Wealth Fund, Norges Bank, to the extent that the largest institutional investors in the world increased their holdings in precious metals from 0 to their 3-decade mean, would lead to a tripling or quadrupling of demand for silver. And that would be a real silver squeeze, a real silver squeeze, a squeeze of a dimension that I don't think that we have seen since the 1970s, a squeeze that would in fact put the efforts of the Hunts in the 1970s into proper perspective. You know, 3 fat boys from Dallas did a pretty amazing thing to the silver market, but nothing compared to what the largest insurance companies and endowments and pension plans in the world will almost necessarily have to do over the next 5 years. I see the need for a behavioral change among individual investors, which would mean that I see individual investors abandoning the course of action that they've adopted over the last 40 years. I think one savings class for individual investors needs to be a medium of exchange that's simultaneously a store of value, which is to say silver or gold. I want to see real rather than fiat liquidity in individual portfolios. And I think that the silver squeeze was very useful in that it taught 1 million young people that they need to have an asset in their portfolio that isn't simultaneously somebody else's liability. That is classical money, which is silver. But the other side of the silver squeeze, I think, will make more impact on the price, which is to say very large institutional investors. Let's look at Norges Bank, Sovereign Wealth Fund of Norway. Their net asset value is now well over $1 trillion. And their holdings of precious metals and precious metals related assets are, to my knowledge, 0. If Norges Bank were to allocate 3% of their assets to precious metals, that would generate, by my calculation, about $30 billion worth of buying. That's the stuff of the silver squeeze. That's $30 billion worth of buying from one motivated buyer. Extend that to Abu Dhabi Investment Corporation, to CITIC, to Kingdom Holdings for Saudi Arabia, to the Stanford University Endowment, to the largest insurance companies in the world, and you understand the probability of a quantum increase in demand for precious metals as a consequence of disintermediation out of debt instruments, where these largest institutions of the world are 40% invested. That's the silver squeeze that I see.